Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 3rd of July. I'm Daniel Lam, your host for the podcast. We spoke about gold 2 weeks earlier. Since then, it has been on a downtrend, which had really started from the beginning of May. Gold had broken below the 1920 to 1960 initial zone of support. So how do we see gold going forward? First of all, let us recap that gold is negatively correlated to real interest rate, i.e. nominal interest rate minus the inflation rate. The hawkish narrative from the Fed, starting from the last FOMC and continuing to last week's statements by Powell, lends support to yield levels, which may put pressure on gold prices in the near term. Technically, gold is on a relatively strong downtrend. If you look at the ADX line, which shows the strength of the directional move, it is at the mid-30 level, and readings above 25 for ADX line is considered to be a strong trend. The chart indicates that gold may correct to 1860 or even 1810 over the next few months. If you check the overall investor interest, which takes into account of the gross longs and gross shorts, it is at its lowest since 2018. ETF outflow accelerated in June, and tactical positioning has been scaled back. Investor appetite lacks conviction in gold. The sharp drop in exposure since the last FOMC does not necessarily suggest imminent short covering activity, but it does underscore a shift in sentiment as we head into a seasonally slower period for demand. However, we do believe that gold can still act as a strong portfolio hedge. There's a risk of Fed over-tightening after the recent announcement. Inflation seemed to be on a downtrend, and Powell's emphasis on driving inflation back down to the 2% level may turn out to be an unhealthy obsession. Because compared to the decades before, where globalization and the improvement in efficiency were the main themes, over the last few years, there's increasing multi-polarization, which may lead to higher inflation structurally. So therefore, if the Fed over-tightens, it may lead to heavy recession in the US and perhaps globally. In that case, gold would be an excellent hedge in investors' portfolios. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.